Department and FDIC said all customers will have access to their money held at the bank starting today. The same goes for depositors of Signature Bank, which regulators shut down over the weekend as well. They also announced other measures to prevent bank runs at other institutions. The situation has a lot of Wall Street thinking how much the Fed will raise interest rates at its meeting next week. Goldman Sachs already changed its view, saying the Fed will not hike rates in March. Morgan Stanley, however, saying that it still sees a path to a 50 basis point increase. Second thing you need to know, the chaos at SVB is reverberating across the banking industry. Bank stocks are declining, with regional banks working overtime to assure their customers that their money is safe. First Republic Bank is leading the drop this morning, with bigger names like Charles Schwab and Bank of America also taking a hit. On the fall, the Federal Reserve unveiled a new program that will better allow banks to manage their liquidity. And third thing you need to know, SVB was the main banker to Silicon Valley, venture capitalists, and startups. And we've heard from companies including Roku, Etsy, Roblox, and Rocket Labs telling us they had exposure to the bank. They should be getting their money today. But at a time when the tech industry is already on edge from massive layoffs and less capital, does this put a deep freeze on the startup industry moving forward? We've got you covered on the latest all morning long, and we go now live to President Joe Biden, who is making comments on this whole situation.
The government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead,
that was President Joe Biden speaking about the collapse of Silicon Valley Bank and also the seizure of Signature Bank. The president emphasizing here that there will be no taxpayer burden as a result of federal regulators coming in and making depositors of those two banks whole. He said that they're now still trying to get to the bottom of what happened, that the people who are responsible have been removed, and indeed the management of Silicon Valley Bank in particular.
Just heard from President Biden assuring the American public that their money is safe. Depositors at SVB will be made whole, and none of these losses will be borne by taxpayers. Investors will take the fall on this. Officers of the bank will be have been fired, and that Americans should be confident that their deposits in their banks are safe. Now, the president saying that we need to get the full accounting of this, and no one in his administration is above the law. He called on Congress and regulators to enact new rules to ensure this doesn't happen again. Now, these comments coming after the president's direction and recommendations from the Federal Reserve and the FDIC last night, spurring Treasury Secretary Janet Yellen to take emergency action to make depositors of Silicon Valley Bank whole and create a new lending facility to backstop deposit withdrawals across our banking system.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S. and arguably the first true black swan event for the market since the meme stock craze. But how did we get here? And let's get you up to speed. Julie, there's a lot to unpack here, and I'm just tracking a good newsletter, the Daily Upside, and they're noting, coming out of the company's most recent earnings report, that was Silicon Valley Bank, they had mark-to-market losses of nearly $16 billion and only tangible common equity of $11.5 billion.
Okay,
just a major red flag.
I'm going to push the buzzer on you right now.
Go.
You said mark-to-market and tangible book value loss. Okay, let's explain to people what the heck all of this stuff means, because especially folks who were not around during the financial crisis or people who forgot what all of this stuff means, it really does. You have to have a little bit of decoding here, right? And a little bit of disentangling. So this bank started back in the 1980s, and it really was targeted at serving Silicon Valley and serving startups and the tech industry, with the acknowledgement that these kinds of companies don't make money until later in the game, right? Over the last decade or so, or even a shorter time horizon, there were just deposits pouring into the bank because we really saw even more of a boom than ever in Silicon Valley, right? You see here what was happening with deposits, followed by a big reversal in those deposits because we all know what's been going on with the tech industry more recently. And then these depositors got a whiff that there might be some issues at the bank, so they pulled their money en masse. That outflow in deposits happened last week alone, which is just incredible. But the other problem was not just the type of clientele, but the type of assets that this bank was holding on its balance sheet. And that's where we get to the mark-to-market stuff, right?
Just complicated stuff. 95% of deposits were above the FDIC's $250,000 insurance limit.
Right.
It's massive.
It was massive. And again, that's on the depositor side. On the asset side, what they were holding is actually not complicated stuff.
Yep.
It's about as vanilla as you can get. They were buying treasuries, right? They were also buying mortgage-backed securities, which is not quite as vanilla, but they were buying treasuries at a time when we were seeing higher prices and lower yields in treasuries. Then the Federal Reserve started raising rates. That means it put pressure on their depositors, aka their clients, and put pressure on those treasury investments. So when I'm a client and I come to you at Silicon Valley Bank and I say, I want to get my money out, and Silicon Valley Bank looks around and says, I don't have that cash, I have to sell these treasuries, I'm now selling them at a loss, marking them to market, marking them to present value, and marking down their value. So that's where it all came to a head.
At the root cause, higher interest rates.
Higher interest rates on both the client side putting pressure and on the bank itself, its asset, its balance sheet, putting pressure on. Down by about 1% as we get out of the gate here this morning. If we look on the intraday basis, although the Dow is doing the least bad of the three, interestingly enough. I was just looking at the trending tickers because I really want to dive right into where we are seeing the most movement here, and that is in First Republic Bank. First Republic down 75% over the past 3 days. This morning alone, we saw it plunge by 65%. It got halted for volatility. That's something that was happening periodically during the session on Friday as well. This is one of the other banks that is perceived as having the same types of exposure, and so it's interesting to see it continue to drop to this extent, even with the measures that were taken over the weekend. You told an anecdote on Twitter where you talked about wanting to invest in some of these types of instruments and some people discouraging you from doing so. Can you retell that for us?
Yeah, we raised capital for Market Reader in Q4, and we did have discussions with some VCs about how to place the proceeds, right? And I've navigated financial crisis in the past when I was at Goldman and so forth, right? So I thought the safest thing to do was to buy T-bills for the proceeds that we had. And we had some VCs that opined, not our investors to be clear, that was too risky. So they thought just bank deposit was a bad idea. So we definitely had a shake-up in how people think about risk, and we're going back to good old basics. The T-bills is probably pretty safe relative to bank deposits, and that's a lesson a lot of people have learned over the last few days.
Mark, this environment was already a tricky one for M&A, for what you do, right? Given rising interest rates, given uncertainty in the economy, what does this then do layered on top of that?
So this is going to be a negative to the market. I would say credit would probably pull in a bit, although credit has been tough over the past number of months. You know, our view about M&A is it's sort of like there's a pending demand. Someone likened it to a car crash on a highway, and the cars are backed up, but eventually that crash will be moved, and then a lot of cars will go through. That's particularly the case for the private equity funds who are sitting on a number of businesses they want to monetize, they want to return capital to limited partners, and so I think we'll see it pick up. It also could have been, maybe I'm an optimist here, but could this be a deflationary event that causes the Fed to pause a bit? Part of the issue about M&A is having certainty on interest rates. And with the Fed continuing to raise interest rates, no one really has a sense of where it's going to end. So how do you price securities? How do you price companies? Having that stability, or at least the view of what will happen in the future, I think will start opening up the markets. And as you know, it's all about price. And right now, there's just simply a disconnect between buyer and seller.
To prevent a nationwide collapse in the banking system, Chinese tech startups also held accounts at Silicon Valley Bank, especially those with dollar funding. While this high drama plays out, some say U.S. regulators could learn a few things from China on how to police the banking system. For more on all this, let's get to Macrolend's chief strategist and managing principal, Brian McCarthy. Brian, good to see you here. How do you think this situation with SVB Bank and even Signature, for that matter, will impact U.S.-China relations?
Sure. Well, it's bad for the Chinese economy, that's for sure. Whenever global liquidity tightens, China, through its still managed exchange rate with the U.S., really struggles to prop up its economy. The Chinese economy is already struggling, despite a lot of optimism about its economic reopening after the COVID-0 policy was lifted. But I'm not really all that optimistic on Chinese growth prospects this year. We had the new premier of China talking fairly pessimistically about the low 5% growth target they set being difficult to reach because of the problems the Chinese economy is facing.
On the events of last week and sort of a timeline of how exactly we have come to the place we are today. Actually, last week, the CEO of Silicon Valley Bank spoke at a Morgan Stanley conference. It sounded like business was usual, if a challenging environment, as we know, which it is for tech. And then late on Wednesday, the company announced that they were going to be raising capital through a three-part share sale. First, just a sale of common stock. Second tranche was a convertible offering. And then third, they were selling it directly to a venture capital firm.
Prudential regulation in this country. Some are handled as Signature was by their state regulators. Some are handled by the Fed. But all regulators have got to be tougher, and they especially have to monitor interest rate risk. What was a solid plan for 2021 is a dangerous plan in 2023.
Average person in America has no idea how to underwrite the risk that a bank has. However, the one thing they should know is that by FDIC, you should have insurance up to $250,000 of all of your money that would be in an account. So in the event you have more than $250,000, it's always good to diversify and maybe open up a savings account, a checking account, and vice versa. And the idea is saying, I don't want to have too much of my risk here in the event a bank was to become insolvent. And I think what we saw was something that was obviously unprecedented, and that was a bank run. I remember seeing things of this such from, the Great Recession and things of that sort. But when you really think about it, or the Great Depression, when you really think about it, you got to understand that all the money that you put in the bank inherently takes it and then loans it out somewhere else, or takes it and make different investments. And if we all were to go to a bank and everyone was to demand their money, the bank actually wouldn't be able to fulfill all of our withdrawals. And so that's what we saw in real time, where you saw Silicon Valley actually have $40 billion worth of withdrawals in a matter of a day.